Infinite Banking, Miscellaneous Part 2, Riders, Paid Up Additions, and Reduced Paid Up. Since the infinite banking concept and the tax-free cash growth warehouse strategy is linked to whole life insurance and depends on the cash value of whole life, it's important to know a few things about that vehicle. This is the second video here on this topic, so you might want to find and watch the first one if you haven't already. And if you think, if I think of more miscellaneous things or you suggest some here in the comments, I might make a third video to explain them, so stay tuned. Aloha, I'm Stan Cox, Principal Broker and Strategist with SC Finance Strategies and Insurance Consultant. I'm also the author of the books on the tax-free cash growth warehouse strategy, and I'm the managing director of the Hawaii Financial Freethinkers Academy, a nonprofit financial literacy education organization. For the past several years, I've focused on and specialized in the infinite banking concept and developing the tax-free cash growth warehouse finance strategy. If you find this to be helpful, please like this video and subscribe to this channel. Also, please post your questions and comments. What are riders? I touch on riders in my books and some of my videos here, and I usually explain what they are and their usefulness when I'm explaining things to my clients. But I wanted to share this illustration that helps to understand what they are and why they are called riders. When I first heard the term rider in this context, I wanted to know why certain policy additions were called riders. If you're driving a car, you are the driver. If you have people with you in your car, they are passengers riding along with you. So they are riders. And that makes perfect sense. Yes? So with a whole life policy designed for infinite banking, we use riders as part of the design for a few reasons. So think of it this way. The whole life portion of the policy is the base component on which the total policy is built. The whole life portion is the driver. The other components of the policy are the riders or passengers. Another way to think of riders, and the way it was explained to me, is the chassis of a car that is the base whole life, and body, seats, engine, wheels are all riders on the chassis. I like the driver-passenger analogy better because passengers can exit the car without ruining the car, where if you were to lose the body of the car, engine, wheels, transmission, so forth, well, it wouldn't really be a car anymore, would it? And riders on a whole life policy can be removed or modified without losing the policy. There are several riders that may be added to a whole life policy, including long-term care, guaranteed insurability, term insurance riders, paid up additions. What is paid up additions? Paid up additions, or PUAR, paid up additions rider, is a rider added to the whole life policy that does a couple of things. First, as with all riders, there is a premium for this rider that will be added to the whole life premium. What this rider does is each time you pay the premium, it buys a little chunk of whole life insurance, which gets added to the total, and so increases the death benefit. And it does this without increasing the premium for the whole life. And while this rider has its own premium, which gets combined with the whole life premium, the amount of whole life the rider buys and adds to the policy stays the same, while the premium for the rider never increases. And while the total death benefit of the policy increases with each premium paid, the premium for the policy never increases, even though the policy is growing. Not only that, most of the premium paid for the paid up additions rider, goes to the cash value of the policy. So the PUA rider is a major contributor to the policy and cash value. And as the cash value grows, the compounding dividend interest paid to the cash value increases. Another rider we use extensively in constructing policies for infinite banking is a type of term insurance rider. We use this rider for a couple of reasons. First, the term rider increases the total size of the policy and the death benefit, and it does so at a lower premium cost than an equal amount of whole life, all other things being equal. That is, age and health of the insured. The other thing it does as a result of the increase to the size of the policy is that the MEC limit is raised. For example, if the MEC limit for a $200,000 policy is $20,000 per year, the MEC limit for a $400,000 policy would be $40,000 per year, all other things being the same. So the MEC limit limits how much you can add in cash value to a policy or pay to the policy in any 1 year. Okay, we have a video here that explains what a MEC is and how it affects the maximum allowable cash load for a policy. So you can check that out when you get a moment. And here's the other thing with the term rider. If the premium for a $200,000 whole life policy is $5,000 per year, the term rider adding another 200,000 will only be about 2,000 a year. So that doubles the total policy for less than half the cost of whole life. Another thing adding these riders does is that it creates additional options for the policy owner. And as I mentioned earlier, a rider can be reduced or eliminated from the policy, lowering the premium that has to be paid without ruining the policy or lapsing the policy. So now we come up to what is reduced paid up option. And this is really a terrific option to have available. When this option is exercised, what happens is the total amount of whole life insurance that has been paid up for to the point when the option is exercised, it is retained. The additional insurance is dropped, and there will be no more premium due on the policy at all. So say the policy has been in force for 10 years and the total premiums paid up to that point, including the paid up additions, has paid for $200,000 of whole life in full. The policy was originally designed as a $200,000 policy. Now I'm going to show you a slide here, so hang on here. I'm going to go ahead and share this. Now, so since we use participating whole life policies for infinite banking, the dividends paid to the account not only grows the cash value, but it also buys a little chunk of whole life as well. So over the 10 years, the premium has been paid and the dividends have added to the whole life. The policy has grown to $306,730. See that right here. And the cash value has grown to $59,000. See that right here. Now we exercise the reduced paid up option, or RPU. The total paid in has paid for $200,000 of whole life in full. So the current $307,730 face value will be reduced to $200,000, in this case, $200,753. Okay. But the life insurance will still be in force at the lower $200,000 face value. And the cash value will remain as it is at $59,000. And here's the beauty of this. Both the face value of the policy and the cash value will continue to grow by virtue of the dividend interest that will continue to be paid to the policy. And of course, the cash value will remain available for leveraging with the infinite banking tax-free cash growth warehouse strategy. That'll wrap this miscellaneous part 2. And if you found this to be helpful, please like this video and subscribe to this channel. Also, please post your questions and comments here. You have questions, we have answers. For a more complete explanation of the tax-free cash growth warehouse strategy, you can watch our 60-minute free webinar. The link is in the description box below. The link to buy my books on Amazon.com is also below. If you'd like to book a free phone consultation with me, the link to my Calendly page is also below. If you'd like to apply to become a client of ours, the link to that application is also below. We're here to help, and we look forward to helping you. Mahalo for watching. Aloha.